In this lecture, we are going to make a brief introduction to the incredibly important and necessary idea of risk management. As it has been mentioned quite a few times in this course so far, it is impossible to become a consistently profitable trader in the long term without applying the basic principles of risk management. Most traders who enter in the market have a primal intuition that making money consistently is all about having very high win ratios. As you might have probably experienced for yourself, it is extremely hard to sustain a high win ratio over long periods of time due to the nature of how markets change from time to time. This means that over the long run, the win ratio of a professional and consistent trader will not be as high. However, that's perfectly okay because we have the amazing mathematical properties of risk-reward ratios to help us as traders achieve the best results in the long term, which is the only thing that matters after all. It's pointless to have good performance in the short term if you are unable to sustain it for an unlimited amount of time. You don't want to be the kind of trader who makes money super fast, but loses all his earnings even faster. It's never enough to stress out that risk management cannot function properly without high-quality technical analysis and deep trading psychology, otherwise we would be able to make money by opening random trades in the market, and we know that this is not the case. For us to collect the benefits of the risk-reward ratios, we need to be able to trade near the edges of the market and we need to train our minds to support losses without triggering certain emotional pitfalls. The first goal is controlled by technical analysis. The last is managed by trading psychology. Without any further ado, let's move on to the lecture that deals with the idea of risk-reward ratios. In this lecture we are going to explore the central element of risk management, which is the risk-reward ratio. The risk-reward ratio is simply the ratio between how much a trader risks and how much he expects to earn in a given trade. In other words, the ratio between the stop-loss order and the take-profit order. By the way, this is one of the reasons it is important to know your targets before you enter a trade. If you don't have any idea where your target might be, you cannot define the risk-reward ratio of your trade, and therefore, you cannot judge if such trade has enough headroom to become a high-quality trade. The risk-reward ratio is so important because it guarantees that we will expect to earn more than what we risk not only in each given trade, but in the long term as well, which is really critical. This brings us to the concept of expectancy, which can be defined as how much a trader can expect to earn in each trade based on the average risk-reward ratios of his past trades. This is why some modes of trading that completely dismiss risk-reward ratios easily fall apart over time. For example, a trader who is after immediate and small rewards and moves his stop-loss a lot to accommodate his biases is silently producing an expectancy lower than 1. This is a deadly mistake for a few different reasons, but the most basic one is that mathematically and statistically speaking, all this trader is doing is expecting to earn less than what he risks, which obviously makes him lose money in the mid and long terms. There is also a severely toxic psychological feature attached to this type of trading because, in the short term, this trader will feel great about his small and subsequent rewards. He will feel like he is really building something great. The problem is that a trader cannot go around the laws of mathematics, so in the mid and long term, it becomes less and less likely that this trader will be able to maintain a high win ratio. In fact, there is too much hype around the idea of win ratios. As you will find out in this course, a trader can make money being wrong most of the time in his decisions, as long as he maintains other aspects of the strategy intact. Before digging deeper into the study of how risk-reward ratios function and their amazing mathematical attributes, let's solidify the idea of expectancy first. Once again, the expectancy of a trading strategy is the average of the risk-reward ratios used in all past trades. For example, in this two tables you can see the risk-reward ratios used in the last 5 trades of 2 trade samples. If we discover the average of these ratios, we will arrive at the expectancy of this strategy. Notice that in Table 1, the strategy uses ratios that range between 1 to 3 and 1 to 5. In Table number 2, the ratios are below 1 because the trader has no real rules on how to manage risk and basically improvises his stop and target decisions based on instinct, which is a really bad idea as we will study later in the trading psychology section of the course. If we take the average of both tables, we can see that Table 1 has an expectancy greater than 1, and Table 2 has an expectancy lower than 1. All this means that the trader using the strategy number 1 can expect to win more in the long term. Meanwhile, the trader producing the strategy number 2 can expect to make less than what he is risking in the long term. In other words, he can expect to lose money in the long term. However, there is a cynical catch at play here. In the beginning of both strategies, both traders will have completely different mindsets. Trader number 1 will probably be a little disappointed because his win ratios won't be that great. However, trader 2 will be building his confidence to dangerous levels due to the high win ratio of his strategy. This is a very misleading exercise. Trader 2 is not aware that his high win ratio only exists because his targets are too close to his trade entries and his stops are too far away. This configuration tends to produce a high win ratio in the short term, but it is doomed to fail over time because, at some point, the market will go against trader 2 and he will be stopped out. That will wipe out most of his small profits and he will be emotionally devastated. On the other hand, if trader 1 is capable of being mature enough to know that a high win ratio is not necessary to make money in the long term, he will continue on his path to become consistently profitable over time. This is a perfect example of what trading really is. This is also a lot like the old story of the tortoise and the hare. The hare is too fast, and it burns itself out too quickly. The tortoise slowly but surely gets where it wants to go. That does not mean that trader 1 cannot have peaks of performance. The better the performance, the better it is for your capital, of course, but high performance must occur within a certain framework that will guarantee its sustainability in the long term. After all, nobody starts trading with the goal of making money quickly, and then losing it all even faster. The bottom line regarding the notion of expectancy is that your expectancy level should be higher than 1. For this lecture, it is important that you understand how the idea of risk-reward ratios dwell at the heart of risk management, and how it affects the trader's behavior in the short and long terms. In the next lecture, we are going to look at the margins of error that risk-reward ratios provide, and we are going to define the best range of ratios in which you should maintain your trades. We already have a firm grasp on the idea of risk-reward ratios and overall expectancy of a strategy, which comes from the average of ratios produced over a certain period. The expectancy is a good metric to measure the risk health of a trading strategy. In this lecture, we are going to look at a more specific attribute of risk-reward ratios, which is the margin of error that they offer. For each level of risk-reward ratio, the trader obtains a percentage of margin of error in which he can rely on. For example, if you trade consistently using a ratio of 1 to 3, you can be wrong 75% of the time in your trade decisions and break even. That happens because for every profitable trade you can make 3 losing trades and break even. Let's see the mathematics of that in a quick example. Imagine, for simplicity's sake, that in every trade you make, you risk 1% of your capital and you expect to win 3% in return. We clearly have a risk-reward ratio of 1 to 3. Imagine also that you have made 2 profitable trades in a row, producing a 6% return on your capital. Since you lose only 1% of your capital if you are wrong in your decisions, you can be wrong for the next 6 trades. Imagine that you end up being wrong in the next 6 trades and you end up breaking even. Let's calculate your win ratio. You made a total of 8 trades and you lost 6 of them. In other words, you were wrong in 75% of your trading decisions, and your win rate was only 25%. By using a good ratio like 1 to 3, you were able to protect your initial capital even while being wrong 75% of the time, which is a lot. Let's look at the different margins of error for the different ratios so we can take this whole analysis to the next level. Here we can see something interesting. As we increase the ratios, the margin of error obviously increases, but the size of the increment decreases. We can observe that by calculating the increment in the margin of error obtained with each ratio. For example, a 1-to-1 risk-reward ratio gives us 50% of margin of error while a 1-to-1.5 risk-reward ratio gives us 60% of margin of error. The increment between these two levels is 60% minus 50%, which results in a 10% increment in the margin of error when we jump from the first level to the other. If we plot the increment column in a chart, we will notice that a decreasing logarithmic curve appears. In practical terms, this means that in the beginning of the table, the increment we get with each risk-reward level is high. After a certain point, the increment in the margin of error starts to get smaller and smaller while the risk-reward levels increase arithmetically. If we want to have some sort of statistical edge in the markets, we must choose a range of risk-reward ratios that is realistic at the same time it provides a good margin of error. In the beginning of the curve, the margins of error are not so good. More towards the end of the curve, the margins of error are good, but the ratios are unrealistic in a trade-to-trade basis. That does not mean that making a trade with 1 to 10 ratio is not good. It's just not realistic to expect that in every trade. Most of your trades should live within the 1 to 3 to 1 to 5 ratio, but occasionally you will find exceptionally good trades that will stand out, and that's perfectly fine, of course. The ability to trade having a good and realistic margin of error is the most important aspect of risk management, because that's precisely what guarantees a certain level of emotional stability and peace of mind for the trader. That's because the trader will not feel the pressure of being right all the time, and he will still be able to make money. This risk configuration also avoids the bad psychological cascading effects that can happen when traders attempt to be correct all the time, as we will see in future lectures. The essential point of this lecture is to show you the optimal range of risk-reward ratios and how we conclude that this is the optimal range. In the next lecture we are going to explore the idea of risk contraction and expansion. In this lecture we are going to learn an idea that serves the purpose of leveling the trading playing field in terms of risk-taking. It's not an absolute necessity to employ the techniques of risk contraction and expansion, but if you want to obtain the full effect of the margins of error of the various risk-reward ratios, you need to level the risk you take in all trades. In real-life trading, the size of your stop losses will vary. That means that the good properties of risk-reward ratios can get a little distorted to the worse side of the spectrum. For example, imagine that you have this series of 4 trades. You can see that the size of the stop-loss orders varies quite a lot in terms of pips. The largest stop is 30 pips and the smallest one is 5. If you end up being right on the smaller trades and wrong in the larger trades, your margin of error can suffer. This is where the idea of risk contraction and expansion comes into play. The goal behind this idea is to use leverage to make all trades risk the same percentage regardless of the stop size. That way, no matter how large or how small the stop-loss orders are in terms of pips, you will always risk a fixed percentage of your account. You can have a clearer view of your margins of error in that way. Let's see how we can calculate the trade size with a simple formula. The formula is quite simple, and it goes like this. The trade size in lots equals the arbitrary risk in terms of capital divided by the size of the stop loss in terms of pips divided by 10. To discover the arbitrary risk in terms of capital, we need to know our equity and we need to define an arbitrary risk percentage. For example, let's say that we have $100,000 and we want to risk 1% of that in each trade. Our arbitrary risk in terms of capital equals 100,000 times 1%, which is $1,000. We divide that number by the size of our stop loss in terms of pips, which is 20 in this example. Then we divide that number by 10, because we know that one standard lot has a pip value of $10 per pip. The formula returns the amount of lots we need to purchase in order to make our trade risk exactly 1% of our equity with a 20 pip stop loss. Let's do the reverse calculation to prove our formula. We know that one lot gives us $10 per pip. The formula returned 5 lots, so our trade would function with $50 per pip. If we got stopped out, we would lose 20 pips at $50 per pip, which gives us a $1,000 loss, which is 1% of our equity. This is how you can quickly calculate the size of your trades if you wish to level the playing field in the way that we described in this lecture. In the next video, we are going to talk about different methods of position sizing and how you can grow your account in an organized way. In this lecture, we are going to explore 2 different methods of position sizing. Position sizing is how you manage your trade's size in order to grow your equity in the most efficient way possible. There are many different types of position sizing methods, but we are going to explore 2 simple methodologies that tend to yield the best results and don't require complex mathematics to calculate the size of your positions. The first method is linear, and we must establish an equity threshold to change the size of our positions. For example, if we establish that our threshold will be 100%, we will only adjust the size of our positions once our equity has doubled. In other words, when it has achieved 100% return. We also need to establish an arbitrary risk level or arbitrary amount to every trade we make. Here you need to decide if you are going to use risk contraction and expansion as it was explained in the last lecture. Let's create a hypothetical example to illustrate how the linear threshold method would function. Imagine that we have an equity of $10,000. In this example, we will use risk contraction and expansion, so we will define our arbitrary risk percentage as 1%. That way, every trade we make will risk 1% of our equity regardless of our stop-loss size. Our threshold will be 100%, so when the account reaches $20,000, we will adjust the size of our trades again, but not until it hits this threshold. 1% of $10,000 is $100, so in every trade we make under the linear threshold method, we will risk $100 until we hit $20,000. Once the threshold is met, we adjust the size of our trades to 1% of the new equity, which is $20,000. From that point on, we will risk 1% of $20,000 until we reach the next threshold of 100%, which will be $40,000. The established threshold can vary, of course. The lower the threshold, the more risk you will be taking, and consequently, the faster your account will grow. However, remember that more risk can also mean larger losses, so be fully aware of that before you decide on which position sizing method you will use. Remember also that you should not use an arbitrary risk that is too high. The reason for that is that the more risk you assume, the more you will be bound to suffer from an amplified state of the cognitive biases that we will be studying in future lectures. The less risk you take, the easier it will be for you to deal with your losses and to manage your emotions in real time. The ideal scenario is for you to find the optimal arbitrary risk level in which you feel comfortable enough to open a trade when the opportunity appears, but you also don't get overwhelmed by amplified emotions. If you want to use the linear threshold method without risk contraction and expansion, you will need to determine a fixed amount to open your trades based on your available margin. That is correlated with your available account leverage, but as a rule of thumb, you should not use more than 5% of your available margin. The procedure regarding the adaptation of the trade size is similar to the example where we use risk contraction and expansion. The only difference is that without risk contraction and expansion, instead of defining an arbitrary risk percentage, you will define an arbitrary margin percentage for your trade. For example, let's imagine that you have $10,000 in an account with 1 to 200 of leverage. You also defined your arbitrary margin percentage as 3%. Since you will be using 3% of 10,000 at 200 of leverage, you will be purchasing 60,000 units, which gives you $6 per pip. Once again, these numbers are completely arbitrary because they depend on your subjective experience of risk. Just remember to not exaggerate because you want to make money fast. That's never a good idea. The other position sizing method that we will be exploring is an extrapolation of the linear threshold method, and it's called moving threshold. Consider that every time you close a position, you have a new threshold, which is the available equity in your account. This can also be viewed as risking a fixed percentage of your available equity in every trade. This is a more aggressive approach that can work for or against you depending on your performance. All you need to do is to establish an arbitrary risk percentage for your trades and make sure that all trades fit that arbitrary value, just like you learned in the risk contraction and expansion lecture. For example, let's say you have $25,000 and you want to risk 3% of your account every time you make a trade. All you need to do is use the risk contraction and expansion formula you learned in the last lecture to adjust the size of each trade. The main difference between the linear threshold and the moving threshold method is the nature of how the arbitrary threshold shifts. The method that you are going to use is completely up to you due to the subjective nature of how each person interprets risk and your tendency to be risk-seeking or risk-aversive. In the next lecture, we will be exploring the idea of shooting stops forward as a method of relieving the pressure of constant risk-taking in the market. In this lecture, we will study the idea of shooting stops forward, which is a way of viewing risk-taking in a way that diminishes the psychological pressure that comes from constant risk exposure in the market. It serves also as a psychological weapon that aims to neutralize the bad emotions that come attached to a losing trade. Trading is not an easy task and traders are far from being perfect because we have many silent psychological flaws. That reality poses a challenge to the trader who responds too negatively about being wrong in his decisions. As we already learned, consistently profitable trading can and will probably be done being wrong most of the time, which is a practical necessity due to the way risk-reward ratios work together with the idea of trade location. However, the great advantage of using the correct risk-reward ratios gives us the possibility of being wrong most of the time, as we already saw in previous lectures. In this video, we will extend this idea a little further with the concept of shooting stops forward. When we risk our capital in the market, especially if we use risk contraction and expansion, we expect to win a certain amount and we expect to lose a certain amount that seems tolerable to us. If we view every trade as a summation of stops, we can have an objective mechanism to create a positive psychological effect that diminishes the bad feeling of losing and regulates the good feeling of winning. Let's suppose that you use risk contraction and expansion, and you risk 1% of your capital in each trade. Instead of viewing that risk as a 1% risk, you can view it as a one-stop risk. You are risking one stop expecting to make 3 or 4 stops with your targets. If the first trade you make is a winner, you can be wrong for the next 3 or 4 trades depending on the ratios you use. If you start with a losing trade, you know that all it takes is one good trade to neutralize the losses generated by 3 or 4 bad trades. The idea of shooting stops forward is quite simple. You simply count how many stops you earned as a reminder of how much you can be wrong without losing capital. For example, let's imagine a hypothetical situation where you win and lose trades in an alternating manner. This won't happen in reality, of course, but it serves to show you the idea of shooting stops forward. With each trade, you count how many stops you earned the right of being wrong in the future. That gives you peace of mind to continue risking your capital without the fear of losing the next trade just because you lost the last trade. That's incredibly important, as you will find out in practice. In the next lecture, we will begin the study of the trading psychology section of the course.